Hey folks, this is Office Hours with Desiree and Malcolm. This show is intended to peel back the curtain on the home mortgage industry and make the whole process more approachable and more accessible to everyone. Desiree Regusci currently serves as the Business Development Manager for Fortis Mortgage, and among other things, she is responsible for educating current and future clients on the ways in which the right mortgage can help make their home ownership dreams into a reality. Malcolm Ethridge recently began working with the team at Fortis Mortgage as a strategic consultant, where he lends his expertise and perspective as a certified financial planner in helping homeowners with unique and complex borrowing needs understand and navigate the mortgage landscape. In each episode, the pair will discuss a particular mortgage topic, share real-world examples, and give you the perspective of the lender, underwriter, and loan originator. So with that, Desiree, Malcolm, take it away.
Hey folks, thanks for joining us. I'm Malcolm Ethridge, that's Desiree Regusci, and this is Office Hours. On this episode, we're talking about the mortgage process for spouses going through a divorce where one person needs to buy out the other partner as part of their agreement. When a couple decides to divorce, it's not all uncommon for one spouse to decide they would like to maintain the home the family has been living in, if at all possible. And while there are certainly lots of factors to consider, chief among them is whether and how you would go about coming up with the cash to buy out an ex-spouse in order to remain in the home following the divorce. So today, that's what we'll be discussing, the different factors that a mortgage company will consider when underwriting a loan as part of a divorce settlement. So let's get started. Desiree, how are we doing today?
I'm hanging in there. How are you?
Yeah, we got to keep the energy level up on such a dark topic. So I'm counting on you to bring some of the energy on this one.
I'll do my best.
Yeah. Well, I tell you what, to get us started off, let's answer that question. Is it even possible to get a mortgage as an individual if you initially purchased the house as a couple?
Absolutely. Yeah. Easy yes.
Okay. Yeah. So if you purchase the house as a couple, though, I'm sure there's something that's going to matter in there if you go and try and purchase, or try and refinance, let's call it, as an individual. What documents will you need to have as part of the underwriting process?
So you caught yourself. So good catch. A lot of people think if they're going to have to actually purchase the house from the spouse, but actually this is a refinance. And we do have a couple options. So I guess the basics as far as the underwriting process and the documents you'll need, all of the traditional income and assets documents, right? So they're going to want to see that, that your income supports the potential payment. If there's any asset requirements, if we get conditioned for, say, 2, 4, 6 months of assets to cover that, then we'd have to approve those funds. And then, of course, they're going to want to see your W-2s, depending on what type of mortgage it's going to be, depends on how many years we'll have to go back. And then, of course, the difference here where it's going to be, you're going to need to show that divorce or settlement agreement because they're checking for a couple things. One is going to be how the equity buyout is written in that contract. 2, they're going to want to see if there's going to be any liabilities that you're going to be responsible for. So if the borrowing spouse is actually the individual that's now going to be paying child support or spousal support, they want to see it because that is a monthly liability that you need to account for in your debt to income ratios. And then, of course, if you're trying to claim income from that, so if you're the borrowing spouse is actually the one receiving those payments, then you have to show that those payments are in there and they will continue for at least 3+ years.
You also made me, when you said the word liabilities, you also made me think about the fact that oftentimes couples who have debt together, when they divorce, you split that debt. And that means that they'd also be looking to see what debts you're going to suddenly become responsible for if you weren't necessarily responsible for them before. So that's a whole other can of worms I won't open, but just one I thought I'd throw in there since you brought up that word liabilities.
No, it's good because I don't think people understand how granular that can be, especially on our side as your mortgage broker. I have to look at every little thing. And so if you've got, 10 liabilities coming up on your credit report, but now you're only going to be responsible for 5 of them, then we have to go in and start working out how to get those adjusted and omitted based off that settlement agreement.
I guess this is why the only thing more expensive than a wedding is a divorce. You start going down that balance sheet and separating and dividing, and it gets anyway. But so on that same vein, right? Thinking about going through the underwriting process, do underwriters look for anything special or different when doing a loan as part of a divorce settlement versus any other type of refi or loan situation?
Yeah, so I think the biggest thing is it's really going to come down to what type of refinance we can do for you based off that settlement agreement. So it's, without getting too into the weeds on this, the settlement agreement has to be written as such where the equity addressed either in the homestead section of the settlement agreement, it's basically has to be written out independently. It cannot be part of an addendum or part of the division of assets. So that's where people don't recognize division of assets where, oh, you're going to keep this house, you're going to keep this house. And now you want to say, oh, I want to refinance it, but I want to do a rate and term refinance because I'm just going to, get them off of the mortgage and I'm going to take some cash out to buy them out.
Mm-hmm.
It can't be, it has to be specifically written in order to do that. Otherwise, we have to take you into a cash out refinance where obviously the rates are typically a little bit higher versus doing a rate and term. So there's a couple things there. So we're going to look at how that settlement agreement is written.
Okay. So this isn't necessarily one that we can just sit down at the kitchen table, jot it out ourselves, and expect to be able to then turn around, go to a mortgage broker and say, here's what we decided, make us a mortgage.
Exactly. I guess that's probably in most divorces, nothing's ever really that simple. So this goes along with that. You probably be as detailed as possible.
Yeah. Well, what are some of the issues to be aware of that could derail this process, right? We're talking about the most positive side, I guess is the way I'll say it, of this process. But what are some of the issues to be aware of that could keep it from working out the way you want it to?
Yeah. Okay. So I guess dividing up the two choices again, if we're going to do a cash out refinance, it's going to be, I guess with either one of these, the borrower has to qualify. Mm-hmm. So that's number one. So this could derail the whole process. If the borrowing spouse does not qualify for the mortgage, then you're going to have to go to the drawing board and remap something out. Most likely.
Say more about that. Why would I not qualify? Based on what?
You could not qualify if the borrowing spouse's credit score is not within qualifying limits. Mm-hmm. Debt to income ratios are too high. You may have in some instances where maybe the borrowing spouse hasn't worked in 5-6 years. They've been, a homemaker. Mm-hmm. And so those numbers just may not work themselves out. So those could be issues we could run into.
So we bought a house based on two people, based on two incomes, but our income is askew. So significantly more expensive house falling to a person with significantly less income, the numbers might not work on the debt to income calculation. Am Absolutely. I saying that right?
Yes, you are. Yeah. Yeah. The other thing that we could run into, again, if you are going to be doing a cash out, the house still has to have enough equity in order to pull that cash out. So that could be another, the home just doesn't appraise for what you think it's going to based off of the loan that's still on there. We call that a loan to value ratio. And so those numbers just may not work themselves out. And then, like I had mentioned before, if you're gonna try to go for that rate and term for the borrowing spouse, which obviously is more favorable, and say the settlement agreement is written as such, they still have to qualify. Mm-hmm. You could have title seasoning issues. So just for instance, this one example, the borrowing spouse has had to have been on the title to the home for at least 12 months.
Okay.
So if for some reason, say one spouse had purchased the home prior to the marriage, they got married, have been living in the house for 10 years, but they were never put on title. You can't do a rate and term if they are not on the title. So that's one. Number two is the borrowing spouse cannot get any cash back. It's only going to the the equity buyout party. And then again, I had mentioned earlier that obviously the settlement agreement has to be written specific in order to qualify for that rate and term.
You actually just taught me a couple of new things there. So thank you for that.
This is the point, right? Great.
Yeah, I was not aware that I, as the borrowing spouse, was prohibited from taking cash out as part of the cash out refi.
No, the rate and term refi.
Sorry, yeah, the rate and term refi.
Cash out. If you're going to take $40,000 cash out of your equity, and you only need 30 of it to buy out your spouse, what you do with the $10,000 remaining is up to you.
Okay, yeah, that was a new one. So I appreciate you thinking to slip that one in there for us. But anyway, I think we did a decent job of keeping the energy up and not putting too much of a dark cloud on a tough conversation. But that'll do it for this episode. Thank you, ladies and gentlemen, for joining us for another episode of Office Hours. I'm Malcolm Ethridge. She's Desiree Regusci. And Desiree, remind people where they can find you if they have questions or want more info after this goes live.
Absolutely. So Desiree at fortismortgage.com is my email. You can find us on our website, fortismortgage.com, and of course through social media on Instagram, Facebook, and LinkedIn.